says that following it's only for limited. Okay, it doesn't work on LinkedIn actually, so
just move this back a little bit. Oh, that's better probably. Yeah. Why do you look tilted? Right.
Huh?
I feel like I look tilted.
What do you mean?
Like I'm like not even.
You probably have to switch your screen, yeah. I think we have we already have a few people connecting. Yeah, okay. That's good, man. Okay, I'm just gonna talk in French quickly. You good?
Yeah, go ahead.
Ok, salut tout le monde. Pour ceux qui nous suivent, merci de venir vraiment en live. Vous pouvez vous connecter sur Facebook, Réussir au Canada ou la chaîne Réussir au Canada. Aujourd'hui, je suis avec Don Chen, lui, qui est un courtier hypothécaire qui travaille avec moi sur le côté financement. Il est bon pour les premiers acheteurs, les investisseurs et aussi les prêts privés. Donc, on va commencer d'ici, on va commencer même dès maintenant. La discussion va se faire en anglais sur comment construire son enquête de crédit, comment aussi vous pouvez maintenir cette enquête de crédit parce qu'en tant que nouvel immigrant, c'est un peu difficile les premières fois. Ok, qu'est-ce que c'est qu'un credit score? Comment je fais? Est-ce que si j'utilise ma carte de crédit, c'est important, etc. Donc, on va voir ça aujourd'hui avec Don et je vais switcher en anglais. Ok? All right, Don. How are you, man?
I heard my name mentioned a couple of times. I'm assuming you're talking about me.
Yeah, but I was saying pretty good things about you.
Thank you. Thanks for the introduction.
Yeah. So I was just introducing you, saying you are one of my mortgage broker. You are specialized in the first-time home buyer, investor, and I guess also you're also offering the private lending. Mm-hmm. We are live on Facebook now and YouTube. So thanks again, Don, for taking the invitation. But let's, we're just gonna talk casually today. I mean, it's not like an interview. And can you maybe just say a few words about you, who you are, how you can help the investors, the buyers, and then we go over the credit score today.
Yeah, and first of all, thank you so much for inviting me and the kind words you mentioned. So I've been a mortgage broker in the mortgage industry for a couple of years now, since 2016, and since the beginning, I've been focusing more on the first-time home buyers as well as first-time investors, first, second, and third-time investors, right? Okay. So these are individuals who are looking to enter the market, and also individuals who are looking to enter the market for investment purposes, or people that are planning on purchasing their first investment property or second investment property. Mm-hmm. So I really enjoy the education component of it, because I think a lot of times people will focus on the interest rates, and there's nothing wrong with focusing on interest rates, and it is very important. But there's also another aspect to it, which is the planning part, that will put the clients in a better position, or in the best position to make a purchase for either investment properties, upsizing, or just building real estate wealth, right? I think at the end of the day, when the strategy or the plan is in place, it'll make it that much easier when it comes to making an offer, and it just makes your offer that much stronger. And we all know, we both have talked about this numerous times, where in real estate, when you're building wealth, you're building something that's tangible, right? And especially given the Toronto market, it's I always like to look at the very fundamentals of real estate's investing, where when there is a large amount of demand and a fair amount of supply, and in Toronto, I would say has been fairly short, it creates a lot of opportunities for appreciation in the market, and also creates a lot of opportunity, when you sell real estate. So it retains its value. I guess that's the most important thing about real estate. So that's my work. I obviously look for the best and the most appropriate interest rates in the market. But I think very importantly, actually to me, it's very important for my clients to understand the process and understand the pros and cons of each option, and that you're protected with the lowest cost of borrowing over the long run, in the course of a term of the mortgage or over the lifetime of a mortgage, right?
Yeah. Two things I like about what you mentioned is education and interest rate. I know like most of the first time buyer, they always want to focus on, I want to have a lower interest rate, because we always think like low interest rate, it's going to be cheaper, and that's true. But one thing I like about your approach is, I know you like to educate the buyers, because can you tell us like what would be the most, let's say, important things about like a real estate mortgage, except the interest rate?
Right. That's a really good question. So one of the things that I have seen over the course of the years, where clients will get a huge chunk of their funding washed away, is on the penalty, right? So penalty is something that is very real, but a lot of people don't really think about. So what is penalty? So if you're locked into, let's say, a 5-year term being the most common and most popular term in Canada, when you break that term, let's say at the 2-year mark, 3-year mark, there is a penalty charged to you as the buyer. And that penalty structure can vary very differently from lender to lender. So just talking about A lenders strictly. So A lenders are the lenders that offer the best rates, the most competitive rates, and they include the 6 big banks, monoline companies, and credit unions, right? Monolines, we refer to them as monolines because they only deal with one line of business, and that is mortgages. Whereas the banks will offer line of credit, credit cards, debit accounts, cash advances, and such. So with penalty fee, the best rate, sometimes it'll vary by 0.05%, 0.1%. Whereas the penalty can vary from 1% of your mortgage balance to about 3 to 4% of your mortgage balance. So if you're not being careful, and you have to exercise a break in your term, imagine you're with a lender and you're trying to upsize to a bigger property, and you have to break your mortgage right now, and you're charged 3% of your mortgage balance. Let's say average in Toronto right now, let's just say it's a $500K mortgage amount. 3% of that, you're looking at north of $15,000. And $15,000 is, relative to the home price, may not be a lot, but if you're using that as a down payment, either for upsizing or for cushion funds or for down payment on an investment property, that is a huge chunk of savings that you can potentially have saved if you had set up the mortgage right in the first place. So, and then there is variable versus fixed. Which one is better for the clients? That's another question I always get to, right? So it really comes down to a couple of things. You got to look at your individual. I always ask the clients, what's your risk tolerance, right? What is your risk tolerance with variable or fixed? Are you going to be sleeping well at nighttime knowing that your variable rate may change up to 8 times a year? That's a very important factor. Now, if you're someone that's more analytical, someone that's more, keep a very close, have a much better grasp on the economics and how the economy flows, then maybe a variable is better for you because you understand and you also are able to tolerate more risk. Right? So those are some of the few factors that go into determining what type of product is good for you besides the mortgage rate.
Thank you. And okay, the reason we're here today, it's mostly to talk the credit score.
Right.
I remember, when I came to Canada 12 years ago, everyone was talking about, credit score, like you need to have like a certain level of point to get finance and everything.
Right.
Let's say now I'm a newcomer. I don't know what's credit score. Can you tell us a little bit more about what it is and how we can start building the credit score?
Sure. So credit score, absolutely one of the most important things, right? 4 things we always look at. And these 4 things are first income, your down payment, the amount of liability you have, and then there's credit score, right? So credit score and liability, they will tie hand in hand. Yeah. So focusing on the credit score. Credit score in Canada, and also would be in the US too, it's a system where the mortgage lenders, or let's just say any sort of lenders, including when you buy a car and you try to get car financing, it's a system where these lenders, money lenders, determine your credit worthiness. I encourage my clients to think about it this way. When you apply for a loan, or a mortgage in this topic, you're essentially asking the lender to give you money, and the lender is acting as the investor. Now, in case of the worst case scenario, and this is what all mortgage lenders will pretend. They'll pretend in the worst case scenario, the mortgage defaults, meaning that the client cannot pay the payments for 3-4 consecutive months, and then they're given another 2-3 months of grace periods. In the worst case scenario, they have to take back, the property and try to sell it and recuperate their money, right? So there's a huge amount of risk to the mortgage lenders, and in order for them to minimize that risk, they basically have to look at a person's habits of money repayment based on a piece of paper. And that is really what a credit score is. It's a credit report, right? So the credit report will tell the lender, has this person developed a good habit of repaying debts over a fixed period of time, and what are the records like, right? Without getting into the specifics about the credit score details, generally in Canada, mortgage lenders want to see that you have established 2 credit lines. So 2 credit lines meaning any sort of loans that you have borrowed and that you're actively currently paying back on. So a car loan, student loan, a line of credit, a credit card. These are all credit lines, and they want to see that you have established a 2-year history, right?
Okay.
2-year history, minimum of 2 credit lines. That's what you need. And
is it like mandatory to have like 2 line of credit? I mean, 2 line of credit.
It's not mandatory to have 2 lines of credit as long as you have 2 credit lines. So these it can be
credit line.
It can be a mix. Let's say you have a car payment mixed with 1 credit card. That's 2 credit lines. Or if you have a line of credit and a car payment, that's 2 credit lines. So in Canada, it's the easiest way to start building credit as a newcomer is to actually get a credit card, right?
Yeah.
I guess it's not very conventional in other countries, but in Canada, that's the case. And I personally have seen numerous cases where my clients, they're applying for a mortgage on their own, and they only have 1 credit card. Exceptions can be made on certain cases, but these clients, the ones that don't qualify, they will come to me and say, well, Don, you see, I pay everything with cash. I'm really good with my finances. And I only have 1 credit card, and I pay it off right away, and I keep the limit very small, right? Fantastic. I believe you. But when I give that piece of paper to the mortgage lender, they only have that piece of paper to look at. I have to show, and you as the client have to show that on this piece of paper, you are what you say you are, right? That is why it's important to have it on paper. So, exceptions can be made. Sometimes if you have 1 credit line and you have a relatively larger limit, let's say $8,000, $10,000, north of $10,000 of limit on it, provided that it's maintained well and it's with a large institution. Easiest way to think about that is with one of the 6 banks, right? Lenders will give you that exception. So the reason being that, again, back to how they judge your credit repayment, your loan repayment habit, they will see that, whoa, you have $20,000 of limit on your credit card. You have a lot of room to use credit, but you have maintained it very, very well.
Mm-hmm.
That is showing the lender that you are a good borrower. And
okay. So basically, yeah, the credit score is to show the lending institution how good we are managing the debt.
Yeah.
Okay.
Yep.
Good. And you said that depends on the income, the liabilities, and
So credit and liability are two of the components. When we generate mortgages, obviously the amount of income you have also matters, right? The more income you make, the higher the ability that you can, qualify for a larger loan.
But it doesn't impact the credit score, right? It doesn't mean if I have a low income, I'm not able to have a high credit score.
Right. Good question. So lower income doesn't necessarily mean that you have to have a credit score. Usually, a lot of times they come in hand, right? So let's say you make $100,000 a year and you qualify for a $500,000 mortgage. On that front, on that one aspect, you're good. But the lender is not going to look at that one aspect. So in the scenario where you're qualifying, you make good income, but you have terrible or damaged credit score, they're going to say, you do have high income, yes, but you're not good at managing your debt.
I see.
Vice versa, where someone makes a little bit less, has lower income, but they manage all of their debts phenomenally. No late payments, no overutilization of your credit. Then that client probably has a higher chance of qualifying for a mortgage than someone with a high income and terrible habit of managing their credit, right? So everything is kind of considered, and we have to look at everything comprehensively in this case in order to give a qualification.
Yeah. Okay. And now, so first thing to do as a newcomer, or like everyone, it's have a credit score, pay the debt on time. I mean, pay the payments on time.
Right.
And how can I increase it?
Right. So first,
credit score?
I would say open a credit card, right?
Open another credit card?
Open. I would say with a larger institution, open at least 2 credit cards, right?
Okay.
Open 2 credit. If you came to Canada, let's say someone needs a car, and you have, that's considered 2 credit lines. And maybe if you're credit card adverse and you already have a car payment, just use that 1 credit card. Like personally, I had 1 credit card for over 20 years.
Okay.
Right? And it's maintained and it's done very well for me. So open a credit line, and that is only on the basis that you're going to maintain it well. So the credit score is not just 1 score. It's a report that has multiple, I guess, categories on it. So there are actually 3 scores that will add up to 1 score. And one of the things that will affect your credit score, right? So first is no late payments. Late payment is absolutely no, right? If you want to, especially if you're new in Canada and you're trying to build your credit worthiness. So no late payments. That is about 35% of, how do you say this? I'm at a loss for words today. 35% of what makes up the credit score, right? Let's say your credit score is 800. So 35%.
Let's say, sorry, I'm interrupting you, but let's say I had a late payment by 1 day and another late payment by 20 days. Is it going to have the same impact?
Yeah, so it's gonna for that category you will have so on credit score you will see there are 3 categories of late payments.
Okay.
So tally up 30-day late, 60-day late, and 90-day late.
30, 60, 90. Okay.
And then it'll show, this person has been late 30 days 3 times. This person has been late 90 days 4 times. Right? And then there's a secret sauce. There's a secret formula that Equifax or TransUnion will use to compute the credit score that you get. But generally, without getting into so much detail about the formula, which I think it's very hard to get anyways. For those, it's very there are a couple of things that are very easy to keep in mind. First, late payments, which is about 35% of what makes up the credit score. The second 35%, which is also very, very large, it's credit utilization. So credit utilization meaning the amount of credit that's in use compared to the overall credit limit you have. If, for an example, if you have a $10,000 credit limit and you consistently utilize $8,000, $9,000, $7,000, you're going to see your credit score drop as someone that is, making late payments. So depending on what the concern, what the issue is, what the source of the damage is coming from, it's, we look at the credit score and really just tackle that one issue, right? So the healthy amount of credit utilization is keeping your usage under 35%. Let's say 40%, right? So a $10,000 limit, again, in that example, on a monthly basis, keep it under $4,000 of usage, right? And then, that makes up about 70%. And then the other, there's a 10% that has to do with what type of credit card you have. So if you have a credit card with TD Bank versus a credit card with Canadian Tire, nothing wrong with Canadian Tire. It's just, it's looked at, it's viewed a little bit differently, right?
Really?
It's more credit. So to put it in an example, if you have a $15,000 limit offered by TD Bank versus a $15,000 limit offered by Tire, the person with a TD Bank will have a better chance of acquiring the mortgage.
Really?
So there's that, and then there's also the very small percentage goes towards another large percentage, which is 20%, is it goes towards your length of time. And this is very important to understand too, where the longer you keep one credit line, the better. So car payment wouldn't be as ideal because in 5, 6, 7, 8 years, you pay it off, right? If you open the credit card, let's say with TD Bank in 2010, right now, you would have 10 years of history on it, even if you don't use it. So the point I'm trying to bring up is when you open a credit card, don't close it. If you use it, put it in a safe place, put it in a shoebox, stuff it in your closet, leave it, right? Or switch it. With the same institution, switch it to a different card and continue using it. Because when you close credit, two things happen when you close a credit. When you close a credit, if let's say that credit card, you already have really good history on it, you have a good amount of time, good amount of usage, you have established history, all of a sudden now you close it. Now the good chunk of your credits that's making up your overall credit score is gone. So left, if it's damaged, your credit score goes down. And the second thing that it shows is whenever you close credit, it's telling the lender that, well, if this person has good habits with maintaining credit score and everything, why is this person closing credit? Is this person running into some kind of financial difficulty where the credit card must be closed, right? So maintain it. Length of time that you have a credit card is very important.
Okay. And now, just before going to the next question, I want to go back to the credit utilization. Let's say I have 3 credit cards, 10,000, 10,000, 10,000. 2 of them, I don't use it, but I only use one of them at maximum 10,000 every month. Is it considered like, then 100% of my credit, or it's just maybe 30% of the whole limit that I have?
Right. That's actually a really good question. So it's, are you looking at the global limit?
Yeah, like let's say I have a global limit of 30 based on 3 different credit cards, but I always maximize one of them.
So no, that's what I do too. Like one of my credit cards gets me 2%. Right? I love using that card because I get a good chunk of money back.
Correct. Yeah.
So so I will establish that I'm by no means a credit expert. I can only give you my 2 cents on the credits I have seen, and I a lot of credits from my clients. So what I have seen is it is based on the global limit, right?
Global limit.
If you have a global limit of 30 grand from 3 different credit cards, maximizing one of the credit cards and keeping that under 30%. So one of yours is, let's say you keep using 10 grand out of a 10 grand limit. Yeah, absolutely. It won't damage your credit score as much as someone that's has a low global limit. On that note, actually, I remembered the point that I want to mention, which is that if you are offered a credit increase, take it. Right.
Yeah.
If you're offered a credit increase, take it.
Always.
But then there's always a something to mention about that, right? Credit card companies, including the banks that issue you line of credit, they have a lot of data backing up that when clients are offered credits, they tend to use it, and when they tend to use it, there's a good likelihood that they're going to make interest, and that's how large institutions make money, right? Yeah. So the thing that you got to be very careful when you increase your credit line is that don't overutilize it. Just because you have a limit doesn't mean it's free money, right? Still use it responsibly. So that's why credit utilization again is very important, right? So. Use it to increase your credit, but don't use it for fun too much.
Okay. I'm gonna have a good question for this after, but now can you share like what is typically seen as a bad credit score, an average one, and maybe like the top one? I mean, what kind of score are we looking at? And ideally, if let's say I'm a first-time home buyer, or even I'm an investor with different properties, what kind of score should I look at?
Right. So generally, there are different tiers of lenders that will accept different tiers of credit scores. But let's just stick with the most competitive A lenders, right? Generally, they want to see at least 620 on your credit score. If you are, so the top limit, and I've only seen one of my clients having that credit score, which is 900. And then
that's the top one.
That's a top. Yeah, that's like gold medal in the Olympics. You're good. And then the bottom would be like 300. I think the lowest I've ever seen is a 450. And you have to try to get to 400. But don't try. Yeah, don't try on that. So generally, I would say keeping it above 620 is a good measure.
Okay.
Generally, what I see people's range around 700, right? 620, you do below 700, especially below 680. Let's just say 680. So I'm going to backtrack. Let's say 680. The reason I say 680 is because recently CMHC, one of the mortgage lender insurers, so CMHC insures all mortgages that have less than 20% down payment. If you put it less than 20% down, CMHC, or what we call mortgage default insurance, is absolutely required. And under CMHC guidelines, you have to have at least one applicant with credit score above 680, or else, otherwise it becomes very, very difficult to qualify. With that said, in Canada, there are 3 insurers in total, and one of the other insurers, they have not changed their guidelines. But it is good measure to keep your score above 680.
Oh, okay. So 680 is kind of the average we should look for.
Yeah, it's below 680, a couple of things will happen with certain lenders. It'll limit your lender options, and it'll also decrease the amount of mortgage that you can qualify for by about 10% in some circumstances, right?
Okay.
So, in Toronto, where prices are high and you want to maximize your mortgage qualification, you definitely want to maximize. You definitely want to make sure that your qualification is maximized by keeping a good credit score.
Okay, but that doesn't mean if I have like only 600, but I have good income, I'm in good credit utilization, I can still get financing, right?
Yeah, you can still get financing. What happened with lower credit scores is that lender options will become more expensive, right?
Okay.
So where we, in some circumstances, we will move into the alternative lenders, or some people refer to as B lenders. Some people say subprime lenders. In this category, interest rates are a little bit higher.
Yes.
Usually around like 1%, anywhere between 1% to 2% higher. There's also fee attached, charged by the lender, and it's very credit score driven rates. Right?
Oh, okay.
Range, you're gonna be at this rate. Below a certain range, you're gonna be at this rate. Right?
Okay.
Yeah.
Okay. And now, I work with a lot of investors, and one day I have this profile. So I think this guy was making over like 100K per year, but he had like maybe 60, 70K as a debt already. I don't know if it was like credit card or line of credit. Let's say, what would be the solution for him to get credit?
Right.
To get financing, to get financing. If let's say you already have like 50K as a debt, or like let's say a credit card payment.
Right. So in that example, it'll be situation dependent as well. It depends on how badly the credit score is damaged, right? Sometimes with a line of credit, if you have a set payment, you're chipping away at because with a line of credit, your minimum is interest only, right? But you always want to chip away at the principal. As long as you chip away at the principal, line of credit sometimes is looked at a little bit differently than a credit card. So if you have a set payment on it and you're chipping away at the principal, it won't damage your credit score as much. In the past, I have helped our clients with debt consolidation, right? In this circumstance, if the client needs to consolidate the debt, either for improving credit score or for improving cash flow on a monthly basis, it is one of the most popular options, I would say, to consolidate that into the mortgage. Basically meaning applying for a higher amount of mortgage and use that mortgage to pay out the line of credit. Because usually right now, especially in this market, mortgage rates are pretty low, and it usually trumps what you can get on a line of credit, right? So it just makes it that way.
All right. So basically, if we want to maintain a good credit score, it's credit utilization, the length of the credit line you have. The first one is the amount. The payment. And that's all of three. It's probably already 80-90% of the criteria. And then it's mostly Okay. All right, guys. Just quickly, Don, I'm just gonna switch in French quickly. So, pour les personnes qui nous écoutent ici maintenant, vous pouvez vraiment commencer à poser des questions dans les commentaires YouTube ou les commentaires Facebook. Je vais traduire les questions pour Don. Si vous en avez une, là, merci, je vois un commentaire de James qui dit que I learned good stuff here. Thank you. But yeah, like if you guys have any question, I'm just gonna keep going with Don. But if you have any question, just feel free to shoot Don. He's gonna answer the question about financing or credit score. Okay, Don, just going back now to the question I wanted to ask. One thing. What?
The burning question.
No, it's not a burning question. Okay, one thing I share with my students is that sometimes we have to take like what I call the OPM, the other people money, to get finance for an investment,
Right.
which could be a credit card, a line of credit, maybe for a down payment for me a few months.
Right.
What do you say about that? Let's say I come to you, hey, I need to buy this, I don't know, this building or this condo. I'm using 50K of my line of credit. How do you see it as a mortgage broker, and how the bank react as this type of financing using a line of credit or maybe a low interest rate credit card?
Right. So I think I'll talk on 2 periods of time, right? So pre-COVID, during COVID. So pre-COVID, definitely there are more lenders that are willing to look at, a line of credit and the clients being able to utilize that towards the down payment of a further purchase. And a lot of times we can do that because the client would have enough income to qualify for a debt. So the thing you got to be careful with that is whenever you take out a line of credit and use it towards a mortgage, a line of credit is still a liability and it's a debt. So the more debt you have on your title, the less mortgage you can qualify for. So I definitely wouldn't recommend someone just out of a whim, take out 100K, 50K. I have $50,000, I'm ready to buy. You do have to start planning very early on and talk to your mortgage professional or go to your bank, someone that can really draw out the plan for you and say, you know what, you can take $60,000 out, but this is the impact on the mortgage that you can qualify for, right?
Yeah, for sure.
It needs to be in balance. And during COVID, what happens right now is because of the pandemic, a lot of people are relying on credit to just get by even, right? And the lenders see that. So what they have pulled back on is using line of credit for down payment. So because the national debt has already increased well above 170%, I think all of the large institutions have a responsibility to keep national debt down. So in a way, the lenders are restricting guidelines on utilizing the borrow down payment as a source for purchases, because you can carry almost 100% debt on a home, that you're purchasing, and that becomes a little bit risky given the current circumstances where everybody's pulling debt, right? And I think part of that scare is also coming out of 2018, where the economy blew up because of defaults. So that's but I think in generally speaking, leveraging what you have, leveraging line of credit is a fantastic idea as long as planned accordingly. And of course, as a mortgage broker, we always have advice and strategic planning to maximize even the line of credits. Right.
All right. Okay, thanks for this. Okay, we have now a few questions. First, thank you, James. I learned good stuff here. I'm gonna take a question from Diamond. So basically, how long does it take to rebuild your credit?
Sorry. So how long does it take to rebuild your credit?
Let's say I'm probably at 600 and I go like maybe to 7. How long is it gonna take if I do everything perfectly, paying, credit utilization? How long does it take?
Okay, so let's use the scenario where everything happens perfectly. I would say reasonably, I would probably say 3 to 5 months.
Oh, that's fast.
Sometimes even within a month or two. All of the debts, I've seen that happen before, where someone carries a lot of debt. Mortgage consolidation happens. This person had $180,000 in debt from line of credit cards. After that's wiped out, usually it takes about, let's say, 30 days, 45 days for the credit card company to report to Equifax, and as soon as you can see your credit score goes up, quite quick. So it depends on the issue, depends on how it's damaged, right? If it's a late payment, it may take a little bit longer, and sometimes the mortgage lenders will ask for why you have a late payment, right? But I will emphasize, if you do have a lot of investor clients, right? So people that have existing properties, never miss a mortgage payment.
All right.
A mortgage payment, you can maybe miss 1 or 2 credit card payments. A mortgage payment, do not miss it. Because if you have a credit score above 680 in the 700, and you had a mortgage payment missed, or 2 mortgage payments missed, let's say in 2019, you have a harder time qualifying with lenders, right? In the lender space, because they don't like that.
They don't like that.
They're mortgage lenders. They're mortgage lenders, and if you miss a mortgage payment, they don't think their investment is safe with you. That's as plain as I can say it, right? All
right. Okay, we have another question from Arno. So thank you for the good stuff here. Between May 9 and June 9th, my credit score dropped by 30 points, although there was no activities. Is that possible, or how? Anything you have to mention about this?
I think it really depends. I don't know specifically, but I would say the first place I would go to. Oh, Arnold. Hey, how's it going? I don't know what happened to you before. So usually that's because the first place I would go to is to check for credit fraud. If there's any sort of fraudulent activities, because credit fraud happens all the time, and I think that's the first place I would go to. If you have no activities, that's a tough one. No credit inquiries at all. And also keep this in mind: your credits, the consumer available credit reports are very different than what I have. It's generally known as a hard pull and a soft pull. So the stuff you get from Credit Karma or even on Equifax, their own websites, it's called a soft pull. And whenever you pull it, it doesn't affect your credit score, right? That credit reports, from what I have seen personally, it'll vary, it can fluctuate up to 60 points or below 60 points from what I see. So it may not just be accurate. Right.
Okay. Maybe for Arno, so maybe check the credit fraud, or probably he got the report from, if it's from Equifax or maybe from the bank. I know sometimes we can get free report from the bank. Which one is the most accurate? I guess Equifax and TransUnion, right?
I would go to Equifax. So in fact, TransUnion and Equifax are the 2 largest credit information centers or reporting agencies. All of the credit card, MasterCard, Canadian Tire, TD, Visa card, they all kind of report to one of those 2 or both. I would say, definitely it would be a good idea. And this is something I would recommend too on a yearly basis. Get a free report. It'll give you a rough range of where you're sitting, right? I always tell clients, if your credit score is sitting in the 700 range or 800 range, there's not a whole lot to worry about. If you're sitting in the 600 range, then there's something to worry about. But one thing for sure, it's that you need to improve your credit score. Either you're using your credit too much, or you missed the payment. Those are the things right? And the things you don't know, obviously, is the fraud. That's something you got to keep an eye on.
All right. I have another question from David. How the points for the credit score will be calculated based on 4 or 5 months if the credit score will be rebuilt? How the points will be calculated?
Right. So I think I feel like this is a question where you're just wondering what are the components that go into calculating a credit score. So when you rebuild a credit, so first thing is identifying what the issue is, right? And like we mentioned before, your late payments is 35% towards credit score. And just to recap on this, make late payments, that's 35% of what makes up the score. And then the other 35% is over usage of your credits. So if you're using more than 35 to 40% of your credit limits on a consistent basis, month after month after month, definitely you're going to see a large decrease in your credits. But vice versa is also that if you cut down the usage, or in specific cases, I will let the clients know that, take a credit limit increase if the bank or the lending institution offers that to you. Take the credit limit increase, because of what that does is it lowers the percentage of credit utilization, right? So that'll help you build a credit score fast.
Okay.
Yeah.
So I guess, we answered the question. It was basically the late payment, credit utilization would be the two biggest one.
Yeah, and never close your credit card. If you have a credit card, don't close it.
Okay. All right. Another question I'm going to have to translate for you is, if we only have one credit score, does that help to get a good credit score? No, if we only have one credit card, does that help to get like a good credit score? Or should we have a different one? I think we answered the question, but
so generally, if you have one credit line, credit card, so in this case, you're talking specifically about credit card. You may have other credit lines. So if you have a car loan, student loan, line of credit, those are all considered credit lines, right? So if, let's say, you only have one credit card and you have nothing else, generally these type of applicants, from what I've seen, their credit scores are not the highest, but they're not the lowest. They're sitting around 700 range. And the reason for that is because on the credit report, it'll show that it'll say client's credit is thin. So back to what I was talking about regarding the length of credit that you need to have is mortgage lenders want to see you have sufficiently two credit lines maintained for at least 2 years, right? So if you only want one credit card and you absolutely hate other credit cards, let's just pretend that's a scenario, and you're not going to open any credit cards anytime soon, ask for the limit, and when they give you a credit card limit increase, take it.
Just take it,
never close that credit card, never have a late payment on it. And once you have a good amount of limits for a good amount of time, you're still going to be able to qualify for a mortgage. Right? You still will be in good standing.
So the main thing to remember is it's better to have at least 2-3 credit lines than just one.
Yeah.
And it could be credit card, line of credit, HELOC, or car loan, student loan. Okay.
I think one point is that if you have a car loan or a student loan specifically, that has a end date to it, hopefully it has an end date. Once that's paid off, it's no longer considered active.
Okay.
Right. It's no longer considered active credit line. So that's why it's better to have a credit card or a line of credit, because it's ongoing until you call them and say, I want to close it.
Yeah. Okay. Now I have a question from Diamond. What would be the minimum score to have? Or I guess is 600? I mean, I guess that would be, what would be the score that would be considered as bad?
Oh, what would be a score like?
Is it like 500, 600, or?
Yeah, I would say bad. I guess I'm assuming that's talking in the sense of acquiring a mortgage. I would say if you're falling in the low 600 range, some actions will definitely need to be taken because at 680, you're above 680, you're able to maximize both interest rates and also lender options.
Okay. All right. Okay, we have a good question here from Pierre. How does that come that our credit score has never been calculated until now? My wife and I both have credit cards, and we use it for 18 months, but still they don't have any track. Is that possible, this? For 18 months in Canada?
It is. I have actually seen that quite a few times.
Yeah.
Sometimes Actually, the first issue I see with that is sometimes they need your social insurance number to pull a correct credit score. So usually we can pull a credit score with name, birthday, and address. But sometimes because those things can be repeated and sometimes there's so much data, social insurance number at the end of the day is the most, it is kind of like the gold standard, I would say, in order for them to pull an accurate credit report. So I've seen cases where I pull it with just the 3 sets of data, and, name, birthday, and address. It shows one thing. And then when I acquire the social insurance number and pull it, it shows a different thing and shows more history. So that could be one thing. And secondly, TransUnion, there's TransUnion and Equifax, right? So it may be worthwhile in your case to go to Equifax and take a look and see if Equifax has better reporting. Because some credit companies, they will report to both, but some credit companies will report to either. Maybe a very simple reason why you're not building credit in that case.
Okay. I got the answer that if they don't have any report from TransUnion, they can go check Equifax. But on the first part of the answer, are you saying that if one day you found someone with the social insurance and you didn't find the same information only with the date of birth, address, and everything, so maybe they can have 2 profiles? No?
Sometimes they can. Yeah. Sometimes. I wouldn't say it's from what I've seen, it varies very slightly. So for example, one of my clients this month, had only 1 credit card. And I'm like, that's a little bit too thin. We got to do something about that. But then as soon as, they provided me with a social insurance number, I don't know why this happens. And this is from experience, I pull it again and there's 3 credit cards and they're all maintained really well. So
I guess the best answer would be go check both TransUnion and Equifax.
Yeah.
Okay. All right. So maybe, you know what? Let's finish with one last question. And I guess that will be my last question. Any update on the mortgage rules or any new government laws that we just had from the government regarding the mortgage, just to share, and then we're gonna just wrap up the call?
Sure. One of the news is actually very much related to credits. So CMHC is the main content of this topic. So CMHC, being the Crown organization, they provide mortgage default insurance for applicants with less than 20% down payment. So mainly into that category are first-time home buyers. So CMHC made a very specific change about credit scores. So if you have 680, if the applicant to the mortgage has a credit score of 680,
yes,
it becomes, they're not considering giving you a mortgage.
Oh, really?
Yeah, and also, well, actually backtrack. They're lowering the amount of mortgage that you're able to qualify for, right? So credit score now becomes important. So this change is focusing on the fact that, again, right now, because of COVID, they're seeing a lot of people pulling on their credits. So anticipating, overutilization of your credit, and people's credit score will change a little bit. And Crown organizations, being CMHC, being a Crown organization, they're funded by taxpayers' monies. So they do have that responsibility to the general public to vet their mortgage applicants and give out mortgages to those who are better qualified. So one of the major changes. However, solutions are always available because there are 3 insurers in Canada that insure mortgages with less than 20% down, and one of the other insurers has confirmed that they're not making those changes. So we are still good, and the minimum with the minimum credit score with those insurers is 620. So that's still good. So for now, I would say for the most part, it's business as usual. But whether the other 2 insurers will follow suit, that's yet to be seen, right? We'll see how COVID develops. Again, unprecedented in the times is, calls for uncertainties. So everybody is adapting and adjusting to make sure that, proper lending guidelines are put up.
Yeah. All right.
One of the major changes. And I mean, the other change, the major change is interest rates. Interest rates have come down quite a bit.
That's always like the main question, like what's the
what is
interest
rate, right? Yeah, so you're looking at like sometimes, high 1%, low 2%, generally around low 2% up to about low 3%, depending on the client's file, what you're doing with mortgage, either you're doing refinance, you're doing 30-year amortization, you have less than 20% down or more than 20% down. Those are all different scenarios. And of course, clients' individual goals and needs will be factored in as well. But, that is compared with pre-COVID, I would say the rates probably have dropped about, by a full percentage or more on the fixed side, right? I'm sure most of the audience here have heard that prime rates, Bank of Canada prime rates have dropped 1.5% since the beginning of COVID, which is fantastic for those who are holding a variable rate. Yeah, you're paying nothing.
Okay.
That's the update.
That's good news. All right. Now, you know what, Don, if one of the people, if we want to reach you, what would be the best thing is it like email? And I'm just going to share your contact information on what is it? Email, phone number? What's the thing you want me like to share it to them?
My number, my email. I usually prefer email because everything can be kind of tracked.
Sure.
Phone number is good too. I usually shut my phone off at 7 p.m.
Okay. So no call after 7.
Yeah. It's not, I will make exceptions, right?
For sure.
A lot of times being family people.
Yeah, I know your wife is pregnant, so
yeah.
When is the due date again?
Oh, September.
Yeah. Okay. Yeah. Quick question. Can you just repeat me your email address? I'm gonna shoot it on the comments, and then everyone's gonna be able to just reach out to you if that. Oh, are you financing only Ontario or Canada wide?
Thank you. So I can do Canada wide. Yeah. There's some
Canada wide.
Yeah.
Okay.
Some restrictions outside of Ontario, but for the most part, I can definitely establish a mortgage outside of Ontario.
All right. Okay, so what's your email address? I don't know it like by.
Here, I'll type it out.
Oh, you can type it? Okay, perfect.
Poland.
Yeah, it's actually a good time to renegotiate the mortgage. Perfect.
I would say so, because right now, one of our lenders is actually pushing out a very aggressive product where at the highest rates of 2.94, that's the highest rate, they're giving a 3% cash back. So 3% of your mortgage balance if you qualify. And then I believe it's 2.84 if you want 2%, and then 2.64 if you want just 1%. This is a product that's, it sounds too good to be true, but it's actually not. There's no strings attached. The only string attached is that, let's say a 2.94%, comparatively, without the cashback, you're looking at a 2.59 or a 2.49. So the interest is ever so slightly higher, but I think the lender just recognizes that because of the lower interest rates, a lot of clients are stuck with a mortgage that have a high penalty fee.
Okay.
At the beginning, when you break your mortgage, you charge a high penalty fee. So in order to accommodate that, this lender is pushing, a cashback just to cover that, and also for those who are in need. I mean, it's a time where people are, some people are getting by very with difficulty, and I think with this type of product, when you switch it over, the money can help, right?
All right. Okay. So I guess you're gonna have someone contact you. Let's talk, and I'm just gonna answer this last question. Yes, Afro Beautiful Canada. Yes, we're going to be able to see the video. It will be on my YouTube channel. Maybe probably for next week, time for us like to edit the video, but yes, it's going to be available for replay for sure. So I guess that's it, done. Anything else you want to say? And thanks again for people who watched the live. Yeah, if you have any question, you have contact information of Don on the comments. So yeah, go talk to this guy. He's gonna refinance you, gonna give you a mortgage or find like a creative financing solution. And yeah, he's a good guy. Yeah.
Find me on the mortgage Don. That's my Instagram handle. Yeah.
Yeah, he's really active on Instagram. So I guess Instagram, that's the one you use most, right?
Yeah. Lately, just being a little bit busy, but I'm definitely going to look forward to putting out a little bit more content. Yeah, definitely. Yeah.
All right. Okay, guys. So thank you very much, and we see you. Thank you for coming. We're probably gonna have a new live next week. I don't know if it's going to be in French or in English, but yeah, Canada is bilingual, so you guys have to make it happen. You know, if you, yeah, okay. A lot of people is gonna show up to you on your Insta. So thanks again, everyone, and we see you next week for another live. Thanks again, Don.
Having me.
All right.
Everybody.
Okay. Take care.